Hi, this is Rob Gabridge with Gabridge Wealth Advisors, here to talk to you about the use of risk assessments in portfolio construction. I'll try not to bore you, but I think it's important that clients understand what we do with the information we collect. Prior to recommending a model portfolio to a client, we need to quantify, to the best of our ability, a level of risk appropriate for the client. Although it does not transfer exactly, we use standard deviation as a risk constraint. Based on conversations and from the use of questionnaires and software, we need to establish the lower of the client's ability to take risk and appetite for risk. Ability to take risk is largely based on the likelihood that the client's assets subject to that risk will be able to fulfill a forecasted plan. Appetite for risk is a level of risk the client is willing to take and still be able to sleep at night while riding out market gyrations. For obvious reasons, the lower of the two is used for portfolio construction. Having established a risk constraint, our efforts turn to constructing a portfolio with the highest estimated return available subject to the risk constraint. This is what we call finding the efficient frontier. The white line in the graph is oversimplified, but is what we consider to be a fundamental illustration of the efficient frontier. Although we generally use far more asset classes and subclasses, for this illustration, I will use only equities and bonds. As you see, the standard deviation is on the x-axis, and the anticipated return is on the y-axis. Knowing the standard deviation based on our risk assessment, and represented here by the letter A, we then attempt to model a portfolio that will get us to the highest available return, assuming the risk constraint. We do this by running models that consider the risk-adjusted returns for each asset class being considered. In this model, we need to test the mix of equities and bonds, obviously summing to 100%, that will move us along the efficient frontier until we arrive at the client's risk constraint, which should establish the highest anticipated return available at this particular risk constraint, represented by the letter B. Again, this is an oversimplified example, but I hope it demonstrates the importance and use of risk assessments in portfolio construction. If you haven't done so already, I invite you to check out our website, subscribe to my blog, follow me on Twitter, and connect with me on LinkedIn. Thanks for taking the time.